inside this trading range here. Until we get out of this range, you have to be a scalper. Okay, so I mentioned that this area here also, this is a volume imbalance. That would be a likely draw up into and above this short-term high, and we got that like gangbusters on Friday. Now, before you think I'm tooting my horn here, just note that this low at 38.22.5, and then this low right here at 38.14.5. Those two levels I was watching as a potential break, and then I targeted 38.14. I felt like we had a really good chance of doing that. The low came in at 38.19 even. On the upside there, this was the draw I mentioned earlier in the week. Whenever I make a notation of a level, especially if it's a daily chart, that is something you want to have on your chart at all times. And it needs to be visible on all time frames. And I'll tell you what that means when we get into the lower time frame charts. But for right now, this is what you should have noted on your chart. So when we see on the lower time frame chart, this orange level here, this rectangle, that's what this is. Okay, it's rooted to this candle's close and this candle's open. Okay, so we're going to drop down into an hourly. All right, here's the hourly chart. And you can see this is the relative equal lows I was looking for as a potential drop down below that. So I was looking for that 38.14 based on these old lows. Okay, so in the event that NonFarm payroll wicked down below that, that would have been what I was anticipating. And then if it would have done that, I would have been looking for something to draw back up into the very minimum right here. And then if it was to accelerate, obviously, going back a little bit further, looking up into here, and this target was mentioned as upside earlier in the week. So we had nice sell side liquidity resting below these relative equal lows. Sell side is sell stops. Anyone that's long or wants to sell short, or is trying to make money going down if the market goes lower, if it goes below that and rejects that, that is a stop raid. And then we would look for the opposing buy side, which would be here, here, and above here. And then if it's really going to have an extrapolation to the upside, that orange box is that daily volume imbalance I mentioned. All right, so we're going to drop down into a 15-minute time frame, and I want you to take a look at this candle right here. Okay, that's Friday. So go to this candle right here. That is the midnight candle in New York local time, right there. That right there is our filter for power 3. Now, what does that mean? Well, for power 3, if we're thinking that it's going to go down, you would ideally want to see a move above it and then go back below it and then create some kind of selling opportunity and then reach down into that 38.14. But we got real close to 38.14. 19 is, in my opinion, close. It's only like 5 handles away. So if we see this run up here on NonFarm payroll at 8:30, so at 8:30, we had a run above that level. But we failed to go back below this low here. And when we go into lower time frames, it'll make more sense. But let's drop to a 5-minute now. Okay, so we have an imbalance here in the form of a buy side imbalance, sell side inefficiency. That means buy side was offered. It's inefficient in what? Sell side. So in other words, it needs to have some movement between this candle's high and that candle's low. So your focus should be right in here. Okay, right in here. This candle's high and this candle's low. There's only one candle between those two candles. It's this one here. And it's one big, beefy, caffeinated candle. Okay. Every time we would create a big candle like this, I would call it a caffeine bar. And it's just a lot of energy. And you hear me sometimes say, I want to see an energetic move. Every time I say it, my mind goes back to the good old days on Merck. But your eye should be gravitating to these types of movements. This is a buy side imbalance, sell side inefficiency. Its category for a PD array is fair value gap, but its distinction is a buy side imbalance, sell side inefficiency. So you can see how we went down into that area here, dipped into it, and then turned around and attacked these relative equal highs. Now, before I drop down into the 1-minute chart, I wanted to kind of take you through this thought process. Right about in here, I tweeted and said, note 38.14, because we could have easily spiked back down through here, cleaned this area up, ran the stops on anyone that was long with stop losses below the old 15-minute low. So here's old lows here, and there's one more segment of price action right there. That's where those sell stops I was referring to all week. So if it was able to do that, that's fine. Then I would have been looking for a run to take these out, but it didn't give me that. But then we get into this area here, which I was watching, but I want to see proof. It cannot, and it rejects this buy side unbalance, sell side inefficiency. What does that mean to reject? Well, it's not getting through it. So in other words, in the easiest language I could provide for you in regards to that, the lowest portion of that range between this candle's low and this candle's high, anytime you have a big one single candle and it's separated with the candle's high before it here and a candle after its low here, and it's just that range that's shaded in blue, there's only one pass, one candle, okay? That is significant when price is coming back down into it. But when there's high impact news drivers like NonFarm payroll or FOMC, it can overshoot these areas. But this purple level here, look what's happening. The market drops back down. I gave it the likelihood of maybe it ran up in here to get above the opening price, and then does it break below this area here and then tag the 38.14 level. Now, if it would have went below 38.14, came up into a fair value gap, I would have looked for a run to 38.04. And you can find that 38.04 level on your daily chart. It's an old daily low. Anyway, because we failed and rejected to go below this level here, you're going to have to drop down to a 1-minute chart. All right, so here's that same buy side unbalance, sell side inefficiency. So we have that drop down in here. Then we rallied. What I was trying to get your attention to was here, okay? This little area right there. If that can stay open, this area here, if that stays open, in other words, it doesn't trade back down into it. Let me highlight it here. All right, so if that area there stays open, in other words, the price doesn't go down into it, and a short-term high is taken out. Here's a short-term high right there. Okay, so this stayed open, and this short-term high was taken out to the upside. There's a small little gap right in here. Notice where all of this is occurring. See this dotted line here? That means that I'm watching to see if this level stays open and if we get above this short-term high right there. Because if we do, then it's likely to do what? Run to take out these relative equal highs. See, in retail books and educators that teach support resistance, which I don't trade, they're going to see that as resistance. It went above this high here, it went up here, stopped, dropped down aggressively. So naturally, anybody that wants to make money, they're going to think, get short. And as long as it doesn't go above here, you're good. Put a stop loss up there, it's fine. Well, I teach my students how to attack retail logic and theory because it's based on fallacy. It's based on things that aren't making the market move higher or lower. It's providing bullseyes and targets for people to hunt liquidity. The market is delivered on the basis of liquidity and imbalance, rebalance. So when the market does, in fact, trade above the short-term high here, any retracements down into this area here, what area? This candle here, from the high to the opening, right at that dotted line. What is that dotted line again? That's the midnight opening price in New York time on Friday. So power 3 is what? We're now thinking it's going to go to here. As it drops back down into this candle's high to open, I'm getting real close to that midnight opening price on Friday. So that means I'm doing what? I'm going to try to buy at or just below the opening price at midnight, because my expectation is if this is what the range is likely to do on the daily chart. Okay, let's say this hypothetical candlestick represents the daily chart. This scenario here. Now, again, think about this candle on the daily time frame. Right now, we're looking at a 1-minute chart, so don't be confused by this, okay? I'm just showing you the logic. The opening price would be this price right here. The opening price at midnight New York local time. That is your daily opening price. You want to have New York at midnight, that opening price. Just pull up a 15-minute time frame and you'll have it. So you want to have that price noted. That's what I have here. Remember, we walked from the 15-minute chart and extended it out in time. If we're bullish, by having this level on your chart, you want to be buying at that level or beneath it. In worst case scenario, you want to be buying near it. So your thought process would be like this. On the daily chart, you're watching where I'm expecting the accumulation phase on the daily range to occur below a specific level. And you'll see how you're in the 90% club. Okay, if you do these types of things and your draw on liquidity, what is that? Well, let's just say that this level up here was the 38.95 and a quarter level. But let's just say that was your draw on liquidity for buy side based on the weekly chart, based on what you expected in terms of higher time frame analysis. But you would be trying to buy below the midnight opening price on any day. Don't think this is just a non-farm payroll event. You're trying to buy at the opening price or below on the daily candle when you're bullish. And if you get above the opening price, like you see it doing here and here, as it goes back close to that opening price, you can be a buyer there too, if there's logic behind it. And the logic I used was these two down closed candles is a bullish order block. It's also a swing high. We went through it here. So this is what I teach you to look for what? The shift in market structure, meaning the market has tipped its hand to you that it wants to go higher. So if it's going to go higher, where's it going to go to? Well, you have an imbalance right here, right? Yeah, that's fine. You have a bearish breaker here. That's fine too. But look closely. Actually, take a step away from your computer screen, back up in your room right now. Look at this chart a little bit further away, about 10, 12 feet away. You're going to see these levels here are way too smooth. It looks too much like classic support and resistance. And here's a note that you want to have in your study journal. And anytime you see levels in your chart that are like this, or they're just too perfect and smooth, I always say this, okay, but smooth edges like to be made jagged. That means when it's smooth like this, the market will rip into that and make it jagged. It doesn't like to have smooth highs and smooth lows. It will always find a way to go back into those levels. It may not happen right away, it may not happen the same trading day, but it will always look to go into those levels again. That's what the algorithm does. So let's go back to our analogy. Let's assume that this level here is this level right there on the daily chart. So that level, for whatever reason, we think there's something up here that is going to be a draw on price. Okay, liquidity up there is making the highest probability that the market will want to gravitate to that level. And that just happens to be on our daily chart. That's the level you would have. Well, while you're watching price, when it's down here like this, meandering around like it was doing here, I'm not paying attention to all of this. This is all based on the reaction to 8:30 in the morning, non-farm payroll. So I'm not worried about this price action. I look at this and ignore it. I want to see where the real range is. It's here. Then they did this fake run. Okay, it looks like it's going to break this, but it doesn't, and tears off, goes lower into our buy side imbalance, sell side inefficiency. Then we wait. Does it break lower? I'm not chasing it. I'm just observing it. I'm watching. I told you, note 38.14. See if it can get down there. It didn't want to do it. Then it rallies away, leaves this area in here. So that's what I was looking for, and I was watching. Obviously, you knew I'm looking at a 1-minute chart. I was commenting over a 1-minute chart. But the market wasn't able to get down to that. And then with this short-term high, it breaks above it. So there's a shift in market structure there. So I'm looking at all of this area here below the opening price, and now this level is this. Conceptually, in my mind, this is what I'm seeing the algorithm refer to. I don't care about this. I don't care about every candle prior to that. See, when you're looking at price action, you're getting caught up in all of this noise. My focus, my absolute focus, is only here. Right there. Inside that box That's what I'm focusing on. That's the initial framework that the algorithm is going to work within. Why? Because that's the dealing range. This is where we are. This is where we made the high for the day. We've left liquidity in place in the form of buy side. We've broke down back into a discount. We have not went lower. We created a short-term high. This range was not closed in or even retraded to. Then we had a short-term high broke there with this candle movement higher. So in my mind, I'm thinking this level here, this line represents this here. So I'm looking at the daily range like this. Even though, okay, that we have traded up here and we've already essentially been here, I don't care. I'm thinking about it just like the algorithm will, if we want to personify the algorithm. So when it's coded to refer to an old dealing range, that's what this is here, this high to low, I believe it's going to do what? Expand outside of that range in the form of external range liquidity. It's going to go outside the boundaries created by this high and that low in the form of a up move. But this little segment of price action, that's the focus. That's the setup. That's the only thing that you would need to be concerned about at the moment. You don't worry about the hourly chart. You're not worried about the 15, the 10 minute, the 7 minute, the 3 minute, the 2 minute. This is it. This is the framework right here. The fact that it shifted above this short-term high right there sets the stage for a run above here. If I'm just looking at this shaded area here, shaded area in here, and I believe it's likely to go from here, if it takes out this high, from here up to here. So I'm envisioning the daily candle looking like this right now. Even though we've already been here and came down, right now the algorithm is thinking, okay, we're real close to the opening price at midnight, which is right there. We ran above it, so it did this. It went up a little bit, and now we're back down inside the middle of the range that would be represented by this low to this high. And then when it drops back down, it's getting real close to that opening price again. So it's doing something like this. Okay. And I'm anticipating that the daily range will now expand up into this level here where buy side would be, which is represented by this high here. That's why this red line is being annotated on the chart. So I'm expecting price to keep gravitating higher, and that would be something like here, and then continuously gravitating towards that high like it's doing here. I'm not getting tricked into thinking it's going to go down. This level is way too clean. Clean being it's smooth. It's like relatively equal highs. The market's not going to leave that. And I actually tweet also, I said, I do believe we're going to go to 3876.25 because it's so close it would be criminal to leave it intact. Okay, so all this time it's dropping down, I'm not worried about it not going up there. So it gives you the confidence to stay with the idea. And then finally, when it runs above it, like that, this is what the daily candle looks like. And I'm going to watch and see, does it keep digging into my next objective, which would be an old high at 38.85. So with 38.85, which being an old daily high, there's buy side above that. Why do I know that? It's just the way it is. Large funds like to use previous day's highs and lows. Fund managers are not pulling their orders in and out. Okay, they're placing them there. They're hard, and it's going to be what it is. It's going to run to them. And that's why that type of perspective on where liquidity is, old daily highs for buy stops, old daily low or lows for sell stops. And you can make a lot of money trading those types of pools of liquidity. They can act as targets and they can act as a framework for entries. Okay, so as you can see, the market does in fact trade up to there as well. And the whole time it's doing this expansion up, higher, higher, higher. And we're not thinking, oh, it's going to collapse in reverse, because the candle, if it's going to have a big move like this, it's probably going to close near or at its daily high. Now think about that. Because if you can do this, you can hold on to the last hour of trading, which would be 3 o'clock, where the market can come back into its range. And I want you to see it like this. Okay, so we can see that it goes up into that daily volume imbalance. Remember that orange rectangle I drew on the daily chart time frame? It goes right up into it. Look at the bodies of the candles respecting the top end of that. Then it drops back down into the low end of it, bounces around, hangs in there, and then leaves it. See that? And here is 3 o'clock. There. So if your target happened to be this daily volume imbalance, that could look like something like this. So in your mind's eye, and tracking what the daily range would look like on a daily chart, I mean, you would obviously have a daily chart referred to throughout the day. That gives you the confidence to stay with the trade, because I get a lot of questions all the time. How do I stay in these trades? How do I not get shaken out of them? Because I'm thinking like this, because this is my concept of power 3. Power 3 is accumulation, manipulation, distribution. So accumulation, smart money's doing longs at that time. I didn't know for certain. I have to wait for 8:30 to come in, do the manipulation, and then it will tip its hand. And I just walked you through that based on that short-term high being broken and the inefficiency for the market to fill in that buy side and balance, sell side inefficiency. So 38.14 was no longer a factor. Then we're going to look for 38.85, and then we're going to look for 38.96 and a quarter. And then unfolded like a script. So in my mind, I'm thinking this is the daily candle. I'm not being swayed by all the little minor fluctuations on these 1 minute candles, which is what makes everybody think that it's noise. It's not noise. It's the same price that the candle's using to make the daily chart candlestick. This is a matter of knowing the rules of engagement and knowing that, okay, once we get to the last hour, 3 o'clock, if it gets to a target like that, be done. Be content with that, because it's likely to do what? It's likely to pull back into the range and create a little bit of a wick at the top end of the candle. So inside this little area now, this little retracement, and it closes off the high. The high here, we're going to say is that. And it may pull off and then close trading for the day right there, that closing price. So we see it over here. Here's the high, short-term low. It breaks, comes back up into a volume imbalance. Where's it going to tag? Sell side right below here. Boom. Where's it close? Off the high there. So it looks like this for the daily candle. Okay. Let's look at the daily candle now. And there it is. I'll go back a couple days ago, last week, and you'll see me actually refer to this level right there. And that's where it's going to draw to, which would be above this high here. The next high would be what? This one. So there's buy side above that, and there's the little volume imbalance. So here's the 1 minute chart. And this is the best I could come up with conceptually going through the individual fluctuations. Just go back and look at Friday, January 6, 2023, and you will see that these tweets are in fact right there, 38.76 buy stops. What is that? That's right here. But here's the buy side imbalance, sell side inefficiency. And over here, let's scrub back here for a moment. Here's a high with a low prior to it and a lower low. So that's a bullish breaker. But this short-term high here, I was looking at this short-term high being broken right on this candle here, the same way I'm telling you this one, when it came through it there, that's a dead ringer. It's going right here. Right there. As that candle's dropping down, bang, right into the order block. This short-term high is a shift in market structure. Now I have two shifts in market structure. This short-term high here, and this gap stayed open. Then we have a shift in market structure above this high with this candle right there. And we have this fair value gap left open. When this thing starts to run higher, I'm confident that I'm on side. Then we have a order block here with this drop down. The market accumulates around it. That's what this little trend line is here on the opening price. And we have a fair value gap. So it bullish order block, trades to it again. It's a retrade. Then it leaves it, then comes back down, and it becomes what? A reclaimed order block there. Okay. So this is not institutional order flow entry drill. Institutional order flow entry drill is when you have an open range in the form of a fair value gap, and it drops down one tick below the framework of the high, like it does here. Look at this candle's low. You're looking at that price right there. This candle's low is what? 38.77 and a half. This candle here trades down into what? 38.77 and a quarter. That's institutional order flow entry drill. What's actually happening is it's high frequency trading. It's being entered there. Okay. There's nothing more I can teach you about it except for the fact that if I trust the fact that these ranges are not going to close in, I'm going to use that as another area to build a partial and build a pyramid position larger. In the event that I do it wrong, I can still be a buyer here and do a pyramid entry. I'm not saying I did it here, but I'm just saying that sometimes I'm buying what I believe is an institutional order flow entry drill, and it goes down and closes in the fair value gap. I'm not intimidated by that. It's okay. It just gives me the opportunity to get in, and then if I have room or leverage still in my equity in my position, if it goes down to the lower end, I can buy again one more time. So whatever position I put here, I'll duplicate that here.